Hello traders, welcome to another video from AM Trading. In today's advanced episode, we will look at several components of candlestick order blocks, trading methods, and price movements. Order blocks are frequently disregarded, yet they play an important role in implementing well-informed trading strategies. They are crucial to smart money strategies. Many traders struggle to identify legitimate and high-quality order blocks, placing their trades at danger. In this episode, we'll get into the specifics of order blocks, dissecting the essential criteria and regulations that elevate an order block to a high-probability transaction. To begin, consider the precise definition of an order block. In the bearish situation, it refers to the zone corresponding to the last bullish candle preceding a sharp and significant downward movement that results in a genuine break of structure. In the bullish situation, it correlates to the area preceding a sharp upward rise, resulting in a valid bullish break of structure. The psychology behind these zones as probable reversal places stems from the concept that they are manipulation areas produced right before a large market movement. Traders see these zones as regions where a high volume of purchase or sell orders have been executed. In the next sections, we will look at distinct candlestick order block kinds, trading techniques, and the psychology underlying these zones. Stay tuned as we break down the important criteria and guidelines that will allow you to find high-quality order blocks and reduce risk in your trades. As we continue to investigate order blocks, let's talk about possible ways to profit from the high likelihood of price reversals and direction changes when they occur at these crucial points. We stressed the importance of order blocks and their function in carrying out educated trading possibilities in our previous section. Let's go on to the following subject, which is how to recognize a legitimate order block utilizing candlestick patterns. Comprehending the diverse situations linked to order blocks based on candlestick analysis is essential to our trading approach. A candlestick-based order block in a bullish circumstance is the last selling candle before a sharp increase in price. Take the example of the bullish diagram where the red candle serves as a valid order block. This candle breaks below the lowest point of the previous bearish candle, effectively sweeping its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before the price starts pushing down drastically. This candle typically breaks above or effectively sweeps the liquidity of the highest point of the previous candle. In order to identify valid order blocks on the market, let's move on to the essential criteria and rules that need to be considered. It is important to point out that the price must take away and remove liquidity above or below the last candle in order for a validated and appropriate block of orders. In addition, inefficiency must be left behind, which will lead to imbalance in the order blocks. The identified order block cannot be considered valid unless there is a proper correction between subsequent candles. Now, we will emphasize on unmitigated order blocks, considering them as one-time use. This means we focus on trading opportunities when price first enters an order block. Once an order block has been mitigated, we do not consider it as an area of interest for trading. By understanding and applying these criteria, we can enhance our ability to identify valid order blocks and strategically use them to our advantage in the dynamic market. Moving on to the next rule. This rule underlines the significance of a high-quality order block leading to a break of structure or a change of character in the market. These pivotal breaks serve as essential signals, offering insights into whether the market will persist in its initial direction or undergo a reversal. To deepen our understanding of order blocks, let's explore more examples. Take a series of bullish candles as an illustration. Initially, the market momentum was bearish until a weak bullish candle emerged, signaling a shift just before a compelling upward movement represented by three substantial green candles. This weak bullish candle not only reached its lowest point, but also effectively swept the liquidity below the previous candle. Examining a specific three-candle sequence, we discern a crucial gap between the candles, indicating an imbalance essential for validating an order block. Meeting the criteria, this candle stands as a valid order block. Moving up the chart, we encounter another notable upward movement marked by a red candle, the last bearish candle before a significant upward thrust. This bearish candle successfully took out and swept the liquidity below the previous bearish candle, creating a discernible gap between the three sequential candles. With all the criteria for a valid order block met, we can now regard this candle as holding the potential to reverse the price, particularly if it pulls back down and mitigates. The detailed examination of these examples underscores the critical role that specific criteria play in identifying a valid order block. In the subsequent segments, we will further apply these principles to real charts, honing our ability to identify and strategically use order blocks in the dynamic Forex market. Besides understanding the importance of order blocks, let's continue analyzing more examples to deepen our understanding. In the second diagram, we encounter a candle that, while representing a movement, does not qualify as a valid order block because it fails to take out the previous candle's low. Before delving into further examples, if you're keen on learning more and view our trades transparently, do join our Telegram group, which has one of the best trading communities. We provide only high-probability trade signals. Join our Telegram group to secure your spot before we close up soon. Link in description below. See you there. Returning back to our analysis, we observe another series of candles illustrated in the second diagram. The price takes the low of the previous candle, effectively sweeping liquidity below it. This sets the stage for a potential candidate for a valid order block. However, scrutiny reveals no noticeable imbalance among these three candles, and the order block is mitigated by the upper wick of the bullish candle. Consequently, this order block cannot be considered valid, as it fails to meet most necessary criteria for validation. It cannot be utilized as a demand zone. In scenarios where the price takes out liquidity from the previous candle but the order block is mitigated, or when the price fails to create inefficiency, we designate the subsequent candlestick as the valid order block. In this case, we identify a bullish candle as the valid order block, diverging from the previous selling candle. This decision is based on the fact that the price has generated a proper inefficiency or imbalance immediately following the bullish candle. As we look slightly higher, we notice the price taking the low of the previous candle effectively, presenting further nuances for our analysis. These detailed examinations of various scenarios help us refine our understanding of order blocks and their nuanced criteria. In the upcoming segments, we will continue applying these principles to real charts, strengthening our ability to identify and strategically use order blocks in Forex trading. In the following section, we'll delve into entry models for integrating into our trading strategies using order blocks. These entry models serve as potent tools for executing trades informed by order block analysis. There are 4 primary entry types tailored to various market conditions such as movement, session volatility, and other pertinent factors. Selecting the optimal entry hinges on these market dynamics. The first entry method involves leveraging wicks to execute trades. After identifying a valid order block, we place buy or sell orders directly on the wick. For sell positions, the stop loss is positioned a spread size above the higher wick of the order block. While this setup widens the stop loss margin, potentially impacting the reward-to-risk ratio, it also heightens the probability of order execution as price may merely touch the wick before moving in the expected direction. The second entry type, known as the body entry, entails placing trades based on the candle body. Upon identifying a valid order block, the entry is made at the candle body. Stop loss for sell positions is set a spread size above the higher wick of the order block. This method often yields a higher reward-to-risk ratio compared to the first type due to a tighter stop loss. However, it carries a slightly elevated risk of missing profitable trades if price only touches the order block's wick without triggering the order. Moving on to the third entry type, my preferred approach involves placing the entry at the midpoint of the order block zone. Upon identifying a valid order block, the entry is positioned at the midpoint. In a bearish scenario, the stop loss is set a spread size above the order block's highest point. This method offers a reward-to-risk ratio at least twice as large as regular entry types due to its refined entry point and smaller stop loss. Its effectiveness in enhancing trade profitability while managing risk makes it my favorite approach. The fourth entry type entails placing the entry based on the candle body within the order block zone. For sell positions, the stop loss is set to touch the higher wick of the order block. This method carries higher inherent risk as the stop loss is positioned within the order block zone. It's crucial to acknowledge this increased risk and carefully evaluate its compatibility with your trading strategy. That is all for today. Thank you for taking your time to watch this video. I hope you found it informative and valuable. If you did, remember to click the subscribe button and enable notifications to stay informed about our latest content. Your feedback is important to us, so feel free to share your comments below, suggesting topics you'd like us to explore in future videos. Thank you for your support, and I look forward to having you with us in the next episode.